about M&A valuation, relative valuation method. This method is an alternative in which we discussed it in previous section. This the method is discounted cash flow. First, I want to explain about relative valuation method. The definition of relative valuation method. Relative valuation methods are based on the premise that the market value of a firm can be valued based on a single measure of value. The value of this approach relies on its reflection of scarce supply and the demand condition for these types of assets. And next, we will I will explain about learning objective. Learning objective is to provide knowledge of alternative to discounted cash flow valuation method. Like I said before, including a market approach. This first is comparable companies, the second is comparable transaction, and the last is same industry or comparable industry. The second is asset-oriented approach. The first is tangible book value, liquidation value, and last is breakout value. This the main idea we will discuss in this session is the market approach and asset-oriented approach. But in this session or in this method, we will also learn about the investment cost approach, and the last is weighted average method. So next is relative value method are used for the three reasons. First is they are simple to calculate and require for fewer assumptions than discounted cash flow techniques. Second is relative valuation is easier to explain than DCF methods. Third, finally, the use of market-based technique is more likely to reflect current market demand and supply condition. And this is applying relative valuation method. The formula is MVT equals MVC divided VIC times VIT, and in which MVT is market value of target company, MVC is market value of comparable company, VIC is measure of value for comparable company, VIT is measure of value for company T, and MVC divided VIC is called about market value multiplied from the comparable company. And this is about the asset-based method. First is the tangible book value of shareholders' equity less goodwill. The second is breakout value, the price of the firm asset sold separately, less its liabilities and expense incurred in dividing up firms. And the third is liquidation value, to determine the minimum value of the company in the worst case of liquidation. First, we talk about the asset-based method in the tangible book value. The formula of tangible book value, or we call it the section, is TBF equal total asset minus total liabilities and minus goodwill. And the formula of asset-based method tangible book value is MVT equal MVC divided VIC TBV times VIT TBF, in which MVT is market value of the company, of course, MVC is market value of the comparable company, VIC TBV is tangible book value for comparable company, VIT TBV is tangible book value for target company, and the last is MVC divided IC TBF is market value multiplied for the comparable company. And next is we talk about the breakup value. The breakup value we call trees. Tree with the tree. This is the target view. The target view is a series of independent operating units whose income, cash flow, and balance sheet statement reflect intra-company sales, fully allocated costs, and operating liabilities specific to each unit. And the number 2 is the unit equity values is determined by deducting operating or non-operating liabilities from estimated enterprise value. And the last is aggregate equity value of the business. Aggregate equity value of the business is determined by assuming equity value of each operating unit less unallocated liabilities held at corporate level, for example, is a debt, and breakup cost, for example, is accounting and investment banking fees. And last is asset-based method liquidation value. For the asset liquidation value is the value asset. For the asset liquidation value is value asset as if it's sold in a larger fashion. For example, it's 9 until to 12 months, and deduct value of liabilities and expense associated with asset disposition. And the last is replacement cost method. First, replacement cost is the cost to replace a firm asset at current market price. Second is all target operating assets are assigned a value based on what it would cost to replace them. The third is each asset is treated as if no additional value is created by operating the asset as part of going concern. The fourth is each asset value is summed to determine the aggregate value of the business. And the last is this plot is limited. Why? This plot is limited if the firm is highly profitable or such as high going concern value, or if many of the firm's assets are intangible. Then okay, and it's done for me, and thank you very much.